I'm Courtney Deegan, and this is the Pricing on the Cake. Welcome to episode 4 of the Pricing on the Cake, the show that's all about growing a profitable business confidently. If you are a woman who's an entrepreneur or a small business owner, then this is the show for you. In today's episode, I want to talk to you about 7 reasons why cover your costs is the worst pricing advice. Now, I'm in a lot of business groups online, especially on Facebook, and now and then there are posts from people asking questions about pricing. They're asking questions, sometimes they're market research questions like, would you buy this? What would you pay? Sometimes they're general pricing questions like, how do I go about pricing this product? And every single time there is one of these posts, there is always at least one comment saying something along the lines of, you need to cover your costs. Sometimes they even go further than that and they say you need to calculate all of your costs. You need to then work out a percentage margin to add for profit. You then need to add this for tax, this for GST, blah, 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 blah. And they lay out the foundation for basically explaining cost plus pricing. Now, the people who are making these comments are very, very well intentioned. And look, it does sound logical, right? Cost plus pricing sounds logical. I won't deny it. It is very simple. It's a very simple formula. It's easy to follow. And I certainly think there is a time and a place for it. If you are a multinational, mass producing grocery chain, right? Like Woolworths or something like that, then cost plus pricing makes a lot of sense if you've got thousands of SKUs. But for most of the people in the business groups online, most people who are entrepreneurs or small business owners, you probably don't have thousands of SKUs. And so cost plus pricing is especially dangerous for your business for a number of reasons. And those are what I'm going to take you through today. So here are 7 reasons why you shouldn't focus on costs when it comes to doing your pricing. The first reason is that costs are historical. You only know something is a cost because it happened in the past. You went out or you went online, you bought something, that's past tense. Whereas your prices really need to be done in such a way that it leaves room for you to grow tomorrow and into the future. If you price based on your costs, then you're pricing based on the business that you had yesterday, not based on the business and the costs that you want to be able to have tomorrow. I see this a lot in creative businesses in particular, and I have actually seen this bring businesses down. A solo business owner might be charging an hourly rate based on their costs, but as soon as they need to bring a subcontractor or an employee on board, they can't afford it because they've always priced based on the costs that they've only ever had. And now that they need a new cost, there's no room in their income to afford it because they're not making enough money. As a result, sometimes they end up working so much more, they end up working so many more hours to try to make more money, they end up burnt out, they end up closing the business down, and it's quite a sad process for everyone involved. The second reason is that costs are internal. They're to do with the internal management of your business. Your prices, however, are external. They are something that your customers see and touch and interact with, whereas your costs aren't. Your costs and your pricing should be separate because they exist in 2 separate parts of your business. Costs exist in the operational side of your business. Prices exist in the marketing and the cash side of your business. The third reason is that costs don't drive your customers to buy. Your customers are driven to buy by their willingness to pay, which is based on their perceived value of your product or service and of your business. Your customers don't care about your costs. They care about whether your product or service can give them the future outcome that they want, which is usually a solution to a problem. The fourth reason is that changes in your costs don't always match up or align with the changes in your customers' willingness to pay. Because your customers are driven to buy by their willingness to pay, this changes all the time. Humans change what they find valuable, humans change their preferences and what they want, and that's okay. but their willingness to pay is normally never connected to your costs. So when your costs change, this doesn't necessarily mean that their willingness to pay has changed. This is another reason why your prices and your costs shouldn't be connected. Now, there is a really interesting exception to this, and it's called costly signaling, which comes from costly signaling theory. But this is something that I'll address in a later episode. The fifth reason is that the amount of your costs aren't always proportional to your customers' willingness to pay. Take software, for example. We're all used to by now paying really low amounts for software. So think of your Netflix bill, for example. But it's really common for software companies to spend a ton of money, millions of dollars, on research and IT and things like that. So if software used cost plus pricing, they'd probably go out of business very quickly, because we're all used to paying really low amounts per month or per week for software now. And so if they charged based on cost plus pricing and all of that money they'd spent on their costs, we just wouldn't buy it. The sixth reason is that focusing on costs leaves money on the table. Let's say, for example, that you work out that one of your products or an hour of your time costs you about $50, for example. There's a lot of things wrong with this kind of thinking, but we'll address that another time. Let's just do this for simplicity today. So one of your products or one of your hours costs $50 and you decide to charge $100 as the price for an hour or a product, for example. But let's say that your customers on average have a willingness to pay of $200. That means then that every time you sell something for $100, you're actually leaving $100 more on the table. Now let's put that out to a year and look at what you could be missing out on. Let's say, for example, that you sell 10,000 products and you make $1 million in revenue, but your customer's willingness to pay on average was twice that. So you're missing out on an extra $1 million of revenue. So when you use cost plus pricing instead of value-based pricing, where you charge based on your customer's willingness to pay, you end up leaving money on the table. And in a lot of cases, it's a lot of money that's being left on the table. Now, the seventh and final reason is that costs are important to your business, but not to your pricing. I definitely don't want to give the impression that costs are just not important at all anywhere in business. Of course they are. You need to know that you're able to cover your costs, to know that you have a viable business idea, to know that you should be in business. This is why initial market research is so important to do. You want to know that there's a market out there who wants to buy your product. You want to know that there's a gap somewhere that you can fill. You want to know that people are willing to buy what you're wanting to sell. If you do that market research and you find out that actually no one wants to buy the product that you want to sell, or people just aren't interested in the idea, then you know then that it may not be a good business idea. But if you get into business without doing that research, and let's say that there's no one in the market for what you're wanting to sell, and then you use cost plus pricing rather than looking at whether people are wanting to buy it or how much they're willing to pay for it, it's just not going to work. Knowing whether you can cover your costs is really something that needs to be done in the beginning and early stages of setting up your business. So in summary, we've just gone through 7 reasons why focusing on costs is not good for your pricing. As a summary, those 7 reasons are that your costs are historical, your costs are internal, your costs don't drive your customers to buy, changes in your costs don't necessarily match changes in your customers' willingness to pay, the amount of your costs aren't always proportional to your customers' willingness to pay, focusing on costs leaves money on the table, and costs are important to your business, but not your pricing. If you would like some more reading or more information on this, I'm going to link to some more resources for you. Please do also check out the blog version of this episode. Whether you're listening to this or watching this now, there's a much more detailed blog post that goes with this episode that I posted recently. You'll find that at my website, courtneydeegan.com. As always, if you enjoyed this episode, please like it, subscribe, give a 5-star review. That's extremely valuable and I'd hugely appreciate it. And if you have friends who are entrepreneurs or small business owners, please share this with them, whether it's the podcast version or the video version on my YouTube channel. I know that this is something that is a really big challenge to a lot of people, and I hope that this was helpful for you. I hope it's helpful for your friends and colleagues as well. If you have a comment about today's episode, or if you'd like to ask me a question, you can email me anytime at courtney@courtneydeegan.com. I will see you on the next episode. Bye-bye.